In this part, I'm introducing cost of sales or cost of goods sold, which is product cost. And for different industries, the product costs have different. For manufacturing and merchandising industry, their cost of sales are different. For merchandiser, their cost of sales is the cost of purchase. For the manufacturer, their costs includes direct material, direct labor, or manufactured overhead cost. According to the cost flow of manufacture, these three we first recorded as work in process. Finally, will become finished goods. Before the goods are sold, the expenditure, direct material, direct labor, and the manufacturer overhead will be first capitalized as inventory. When it is sold, it will become cost of goods sold or cost of sales, which is expense. And this is also true for the merchandiser. Purchase will be recorded as inventory. Before the inventory are sold, it is still the asset. When sold, it will become cost of sales. No matter merchandiser or manufacturer, they earn a margin from their sales. Actually, their sales revenue subtract cost of goods sold or cost of sales is the gross margin. To determine the cost of goods sold, not only relies on these expenditures, we also should consider the assumption of the cost flow. Several methods. One is weighted average, FIFO, first in, first out, LIFO, last in, first out. So for the FIFO, because first in will be first sold, so the cost of goods sold will reflect historical cost of the inventory. LIFO, last in, first out, so the cost of goods sold will reflect current cost of the inventory. Physical flow of inventory are not necessarily consistent. Okay. So for example, for Walmart, most of its goods physically is FIFO, first in, first out. But Walmart is still allowed to use one of the three assumptions. The purpose of the assumption is to more accurately show their periodic income or earnings. For these three different assumptions, one firm can use a combination of the cost flow assumption for different products in different business segments. So there are a lot of freedom for firms to choose their cost flow assumptions, which have impact on the firm's cost of goods sold. So that's why we should understand or read the notes to learn what cost assumption the firm use. Sometimes, if we want to compare A and B firms and they use different cost assumption, A use LIFO, B use FIFO. So that means their cost of goods sold using different assumptions. We cannot simply just compare their cost of goods sold by the number. To solve this problem, we need to convert LIFO to FIFO or FIFO to LIFO. Actually, the conversion is not difficult. Let's first review a formula we used. The beginning inventory plus purchase, I use merchandiser as an example. So this equals the goods available for sale. It equals to the ending balance of inventory plus cost of goods sold or cost of sales. This table used to convert between two different methods are built on these formulas. The sales subtract cost of goods sold is gross margin. How to get the cost of sales? From this formula we learn the beginning inventory plus purchase subtract ending inventory is cost of goods sold. Is beginning inventory plus purchase, it is good available for sale, and subtract ending inventory. If the firm use LIFO assumption, we want to convert to the 5. All these numbers are available, and also adjustments also are given in the notes, which shows the difference between LIFO and FIFO. There is only 2 adjustments. All other numbers we just copy it or recalculate. Let's use this example. So this firm use FIFO to report their inventory. Sales revenue, the cost of sales is this one. Gross margin, this one. Okay, beginning inventory basically is ending balance of last year, this one. Purchase is not given. Beginning inventory is here. The ending balance of 2011. Ending inventory is this one. Because cost of sale is available, ending inventory is available, so the goods available for sale is available. Then we can calculate the purchase. Basically, it's the difference between goods available for sale and the beginning inventory. So all these numbers are available. And these two adjustments are given in the notes. It said FIFO basis beginning and ending inventory are 607 200,000 and 763 200,000 higher, respectively, than the amount reported on the balance sheet under LIFO. Okay, FIFO is greater, right? So we add. After adjustment, this is FIFO beginning inventory. For the ending inventory, FIFO is also greater than LIFO. Again, we add. So the ending balance of inventory is 2,930,000. All others we keep. And this one we need to recalculate because the change in the beginning inventory. Then we can get the FIFO based cost of sales and the gross margin. If you compare both cost of sales and gross margin, there is a very significant difference. So if we analyze a firm's income statement or earnings without considering what cost assumptions the firm use, especially when we compare two firms in the industry using different cost flow assumptions, you may not get a right conclusion.